Welcome to the daily update, where I'll go over the action in the market from Monday, March 3rd, and we'll see how things look for Tuesday, March 4th. March 4th, here we go with a bunch of tariffs that are supposed to kick into gear. Market doesn't really like that. Apparently, there wasn't any kind of negotiation, at least up until the time I record this. Something could always happen in the 11th hour. We'll see, but the market's back to looking more negative. We had worked off pretty much the extreme negative condition in the short term after Friday's bounce, and it looked like we were holding up above the 200-day moving average for the NASDAQ. That didn't carry through into Monday. It carried through into the open. Europe was up strong. They really liked this whole Europe helping Ukraine type of thing, and the markets really bounced there. And it looked like, okay, maybe we're going to have a positive open on Monday. We had positive seasonality for the day, but really right after the open, that's when we set the high for the day. We chopped around, and then when the smart money came in, they started selling and took us quite a bit lower. Okay, so let's go back and talk about what happened. We had a higher open, and that's where we set the high. We quickly fell below the unchanged level. We found support at the daily pivot at 59.17, and then we climbed back to the unchanged level. So there was this post-open choppiness that's been happening lately. That's why I watch what goes on later in the day, usually after lunchtime, Eastern time. That's when the smart money says, okay, we're going to come in and buy, we're going to come in and sell. All right. Then pieces, that's very good. Prices broke back below the daily pivot and then they tried to stabilize. We just chopped around a little bit, but after going back down, then we saw late day selling, which took prices below S1 at 59.75. So, yeah, here we go. But we found support at Friday's S2. We didn't get to S2 because the range was pretty high on Friday. That set the pivot points up for Monday to be quite wide, and we didn't get quite down there, but we did see some support at S2. Now, I'll point this out later. The 200-day moving average for the NASDAQ 100 is still holding. Now, we broke it on the NASDAQ, but the NASDAQ 100, it's still there for right now. So there's a little bit of hope. I was watching that and we've held above that at least to this point. But we were down 1.76% on above average volume. We are negative in the short and intermediate term, and we're seeing more of a defensive shift. Growth is just getting hammered right now, but internally in the S&P, things are holding up. We're not really falling apart when we look at the advanced decline line or the new highs, new lows. They're actually looking pretty healthy, but that's likely due to a rotation coming out of growth into value. Interest rates continue to go down, as seen more as of a flight to safety. And there's all these things going on right now. There's the whole debacle from last Friday between the Trump administration and Zelensky and what's going to happen with Ukraine, and then with Russia in the mix and China in the background and Europe changing. And yeah, it's a big chess game. It's not. I mean, I don't go into political things in these videos or in the program that I have, but it's not out of control. There are things in motion right now that is part of a plan, and it depends on what side you think that plan is on, whether it benefits Ukraine or Europe or the US or what have you. It's being played out, but it's going to take some time for it to become a little bit more clear. And then President Trump is supposed to address Congress Tuesday evening. And of course, the side that hates him will just declare all the terrible stuff. And the side that likes him, they'll just declare victory about things. So, yeah, there's real debate going on back and forth geopolitically, which is now having an impact on the stock market. Usually it doesn't. Typically, Wall Street sees what goes on in Washington, D.C. as political theater, and they don't really pay attention. Well, there's so many changes going on, and things are really having an impact on, instead of just the status quo, saying you're going to do one thing, but really just doing what's already been done in the past. There's actual change going on, and the market's trying to adjust to what that actually means. Okay, so there was late day selling following President Trump confirmation that these 25% tariffs on Canada, Mexico, they're going to happen. Now, it could change, but as of right now, it looks like they're going to happen. Then also the tariffs on China, they'll increase to 20% where they had been at 10% on Tuesday as well. And then there's concern about economic growth. We're seeing weaker than expected economic reports that are coming out, and I'll deal with that here again in just a moment, where they're getting concerned. Now, we're going to have the employment situation report coming out on Friday. That's a big one. We're also going to get the ISM services report that's going to be coming out. And there's nothing on Tuesday. There's going to be a lot of economic reports on Wednesday. And is that going to feed into this concerns about the economy, or is it going to show that maybe things aren't as bad as anticipated? All right, then mega caps and growth, they're underperforming. We're seeing money coming out of the mega caps, out of growth, going into value, getting more defensive, similar to what we saw at the end of 2021 going into 2022. Now, we could still bounce out of that, but we're still back to this point of seeing things getting more defensive. And the VIX is up over 20. We're at 22.78. Yeah, that's when we start to see negative annualized returns with the VIX. And the NASDAQ's now below its 200-day simple moving average, with the 200 simple moving average holding for the NASDAQ 100. And they last Friday and then over the weekend, I pointed out that the GDP Now forecast put out by the Atlanta Fed, it was positive, then it went down to 1.5%. Well, they readjusted it on Monday. Now it's down 2.5%. Now, this is just a forecasting tool, and this number usually it ends up being quite a bit different than the real GDP number. But this has folks concerned. And on a short-term basis, where we pretty much had wiped out the list after Friday, we're back to a pretty long list now. We're going up with the VIX, and as measured by the momentum, the RSI based on 9 periods, that's getting extreme. The VIX really climbed up and it's above 20. Of course, we see the Stochk RSI, the Williams Percent R, CCI 1420, stochastics. Those are the usual ones that if we're going up, they're extreme positive. If we're going down, they're extreme negative. Now, the one thing that we're waiting to see, and we'll only see this played out over a period of time, is that the long-term trend is still positive. That's why when we get to a short-term extreme negative condition, I watch things a lot closer. And if I'm in bearish type positions, which benefit when the market goes down, I'll pull the trigger a lot quicker than if we're seeing really positive momentum and the long-term trend is also positive. We can ride that for a while. But a lot of times the market's looking for an area of support. It found it on Friday at the 200-day moving average with the NASDAQ, and we bounced up from there. Right now, we're dealing with the 200-day simple moving average for the NASDAQ 100. And then there's other areas that I'll point out here. But this list now is back to long. For Monday's video, we just had a couple of things on here. The stochastics are still there. We're starting to get extreme with our short-term oscillator, the slope oscillator, and the boom indicator based on 20 periods. We're getting far away underneath the 20-period moving average. And I'll show you charts of all these things. No real changes to the scenario yet, anyway. The dollar was down, which could have given some support to stocks. It had been bouncing up kind of nicely last week. Well, it went down this week. And that could be more geopolitical, just the tensions right now between Ukraine, Europe, the US, and so forth. But interest rates keep going down more as a flight to safety, where money's coming out of the stock market and going into the bond market. Now, there's another part of the stock market that's becoming more defensive because if you are a mutual fund manager or an ETF manager and you have a mandate that says we have to be invested all the time, you can't go from the stock market to the bond market unless your mandate or your prospectus says you can do that. All you can do is go from one area of the stock market to another area of the stock market, which tends to be a more defensive posture. And that seems to be what we're seeing. We were seeing it last week. We didn't see it on Friday. It looked like maybe we're shifting back to more of an offensive stance. Now, in Monday's session, we're back to looking more defensive now. But we're down at 4.18%. What's going to happen if interest rates keep falling and we get down under 4%? The stock market might really like that. And interest rates going down, at some point, bonds are not going to be seen as attractive anymore. the interest rate's going to get too low. And folks are going to be like, okay, maybe the stock market's got hit enough now. We can go back in and start buying stocks. That I'm not saying anything like that is going to happen at any time. It's just something that we watch for, and we watch to see if that will be played out that way. Where after Friday, we were at 4.23% with the 10-year yield. And we actually came up a little bit with sentiment. We're still below 25. So that's when we start to consider using this as a contrarian indicator, meaning folks are so negative on things. We were at 18 after Friday, and we actually bounced up to 24 on a down day, which is kind of usually if we have a down day, sentiment goes down. If we have an up day, sentiment goes up. We didn't see that on Monday. And we're still inverted with the 10 to the 3 month yield curve. And I'm going to show you that later with a chart. And I'm also going to show you the 10 to the 2 year to show that it's not inverted yet. And we are negative with our trend. The ADX is still above the moving average. It's going up. It's getting stronger. We're getting closer to that 20 level. We're already above 20 in the short term, but we haven't quite got there with the intermediate term. And with the down day, our bias is negative, and then the last number of days taken together, that's our momentum. That is also negative. We did get some economic reports. I don't have a chart for this one. Really, the takeaway from this, the global US manufacturing, is it above or below 50? That's the takeaway. It came in at 52.7. That's showing expansion. When we're above 50, expansion. Below 50, contraction. And it's up from the previous reading of 51.6. This was the big one for the markets. ISM Manufacturing, it came in above 50, but not very much. This is even when we were having trouble 6 months, a year ago, 2 years ago, this was still hanging in there. We're still manufacturing things, but it's down. Last time it was at 50.9. They expected it to come in at 50.7. It came in at 50.3. This is what started the selling about 30 minutes after the open because it comes out at 10 a.m. Eastern time. And the market looked at this and went, okay, we don't like what we're seeing here. And construction spending they expected it to be unchanged. It was actually down 0.2%, or last time it was up 0.5%. All right, here's some charts here. This is the ISM manufacturing. The total reading, hard to see because this yellow line's in the way, but it's coming down just a little bit above 50, or the orders are actually dropping below 50. And the market doesn't like this. This is some of the economic growth concerns that the market is currently fixated on. And the ISM prices, they're going up, and but deliveries are going up too. That could be inflationary. And the trade, it's coming down with exports and tariffs anybody, and it's going up with imports. Tariffs anybody? These numbers could really change drastically. And the index still above 50, but coming down from the previous reading. Construction spending on a year-over-year basis is now declining, but it's still above zero. Private construction spending versus residential and non-residential, going down with the residential, that's the blue line, going down with non-residential. And then on a month-over-month basis, it had been positive, although coming down. Now we're actually getting a negative reading here. Okay, so what's the consensus earnings per share growth estimates? They're coming down. They're still positive. Looking out into the future, and I deal with this over the weekend in the intermarket analysis video. I look at historical earnings that have already come out, then we compare that with where things are at right now, and then we look at forward projections with the forward-looking PE ratio, and that's closely related to the growth estimate or it is going down. And Goldman Sachs is even starting to lower that a little bit more. It's ultimately earnings what drive stocks. If you have growing earnings, your stock goes up. If you have earnings that are going down, stocks go down too. They may gyrate around, and there's companies that I remember when Amazon first started trading, it was years before they actually turned their first profit, but the stock was really going up and up and up anyway because folks are buying future hope. Okay, and then Goldman Sachs top-down forecast for the S&P. Well, look at this. They come down with their earnings, but they're here it shows that they're still going up. Imagine that. And they expect us to be at 6,500 in 2025 here, probably close to the end of the year. Okay, that kind of goes against this chart that we just saw. And then what's the probability? of going into a recession. This is actually dropping off. I mean, you wouldn't know that by how the market's acting right now. They're forecasting this to actually come down. Now, this could change. This is just one way that things are measured by a lot of this could be because we're seeing more of a defensive shift, and under the surface, the different markets are holding up for the most part. Okay, then seeing a lot of money coming out of crypto, even though there was a major announcement over the weekend by the president. So yeah, this Bitcoin reserve, that's kind of what everyone's calling it. It seems like when we hit that 100,000, because a couple of years ago, and I have a course both on YouTube and Rumble, and I do a section in that course. It's a basic course, and it's a few years old now. And of course, my intentions are to re-record it with more current information. But some of that, the information doesn't change. It was true 3 years ago. It was true 10 years ago when I taught this course. But I did a section on cryptocurrency just to have a base of knowledge around that, especially on Rumble, because I was posting this. Well, at that time, we were into the high 50s, low 60s. This is before the big crash in crypto. And man, people are just lambasting. 'Cause I was just pointing out, look at the charts. There's multiple head and shoulders patterns inside of head and shoulders patterns, which is a very dangerous thing from a technical analysis perspective, even though I don't use a lot of patterns in what I do. And people like 100K, 100K, 100K. That's what I kept hearing over and over. Well, it went to like what, 25,000? I mean, it just tanked. And that took care of all the weak hands, the people that really didn't know what was going on. They just heard from their friends that this is a cool thing to do. They may have watched a couple of YouTube videos or even went to a weekend conference, and now they think they're experts on this stuff. And they're just coming at me with all these things, which is fine. I'm just looking at the evidence. I'm not either saying it's good or bad. I'm just saying, look at what we see here. And they kept going 100K, 100K, 100K. Well, eventually we got to that 100K mark after the big downturn. And it seems like we've kind of stalled out there again. Was that everybody's goal? Because now we're seeing a lot of money coming out of crypto that had been going in before, but now you have ETFs that are involved. You've got institutions that are involved. Over the weekend, there was an announcement and Bitcoin got a bit of a bump over that, but it's still not able to get back above 100,000 as of the time I record this. Now, I'm not here to say good or bad. I'm just trying to present what is happening here, and we're seeing a basic shift right now. Even though I don't, crypto is not part of my program. I just deal with stocks in general and the S&P 500 in particular. But I watch these other markets at the same time. Okay, then equity positioning, a lot of stuff going out. And you can see here that there's been some freaky stuff going out. Now, on one hand, yeah, the market's getting more defensive and it's been under pressure. On the other hand, it's like short-term pain, long-term gain. It depends on your perspective. If you hate Trump, everything he does is evil. He could come out and say, "We've got a cure for cancer." I'm siding with cancer. Okay. And, or if you really like Trump, anything he does, it's like, this is part of a bigger strategy. Just give it some time to work its way out. There's a lot of paradigm shifts going on in the world right now. And so it requires looking at things in a different way. You can justify either thing here, but we're seeing money coming out as some of these, especially US related announcements are coming out as well. All right, then this really wasn't on Twitter or X. This is from Edward Yardeni. This is part of what the market's getting concerned about. This is the economic surprise index. When this is going up, the economic reports are coming in stronger than expected. When we're dropping like what we're seeing right now, the economic reports are coming in weaker than expected. And that's when I say economic growth concerns, this is what's happening right now. All right, so here's our intraday chart and look like, okay, maybe we'll get a nice little bounce. We saw some late day buying on Friday. We saw not really, we saw some improvements. We bounced off of that 200-day moving average, which was right down around here, even though it got set on the NASDAQ earlier in the day. But the S&P built up a base, and then we saw late day buying. And then a real big spike, which took us back up to about Wednesday's close by the time we closed on Friday. And it looked like, okay, maybe we'll get some follow through here. And it lasted about 10 minutes. We went up, we set the high, we didn't quite get up to R1. And then this is where we saw the selling. And at best, we didn't see really any buying, but we didn't see massive selling for a while. This is the open in here. We came back down to the daily pivot and then chopped underneath the unchanged level. Then later on, this is when the smart money said, okay, we're going to come in, we're going to do some selling. And they went down below the daily pivot, tried to stabilize here at the 5,900 level. And it looked like maybe that would have a chance of actually working out. That's a round number. And then we came back up, hit the daily pivot. And then the real smart money, they're like, no, 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 no. We're taking this baby lower. We're selling. Breaking down below S1. S2 is actually down below the chart. We didn't quite get that far. We came down about to this pivot point from Friday's session, and that's where we found some support. And then a little bit, this is probably people buying that are short sellers and they're closing out their positions because they've made a lot of nice money and a little bit of late day buying going on as well, just to buy low and sell high with the hope that we're going to go up. All right, so not much of a change, pretty quiet in the initial overnight session here, but we were positive. Europe was really strong, and the futures were looking pretty good until we opened, and this is until we opened for the cash session in New York. And this is what we've been seeing. Now, if you've been watching these videos for a while, a few weeks ago, a few months ago, we would see most of our gains or losses produced by the gap from, let's say, Monday's close to Tuesday's open or Friday's close to Monday's open. And the futures would be either up or down, and we would have a big gap there. We're not seeing that now. We're seeing it's like the futures are saying good things should be happening, and then that lasts for about 10 minutes after the open, and then we see selling after that. So most of the action that we're actually seeing here is happening during the day while the stock market is open instead of while the stock market is closed. And we're still seeing more weakness here. We bounced up a little bit on Friday, but the blue line is still below the red line. That means on an intraday basis, growth is underperforming value, even though they're on different scales. And now we're in a full-fledged downtrend here. I tried to make this a little bit longer. For a long time, I was pointing out this bottom at the end of January, and it looked like, okay, smart money's coming in. They're doing buying, doing buying. Now they started to sell, and this is continuing to go down. And this is more negative for the market. They're getting out of growth and getting into value because this ratio looks at growth versus value. So this shows how is growth doing. If we flip this chart upside down, it would be really going up, meaning value is outperforming growth. All right, end of day, look at growth down 2.48%. Value was down too, but a mere 0.97%. And the mid cap growth got hit, small cap growth got hit, but so did small cap values. Small caps are just getting hammered, and mid caps right now, no matter how you look at them. Then this middle area, these are the corresponding ETFs. This is SPY, this is MDY, I believe. I'm not sure if this is IWM or SML. I'm not there's a couple of different small cap ETFs. And we're still going down with the growth to value ratio for the small caps. We're below the 200-day moving average. But longer term, we have been in an uptrend. Mid caps fell under their 50-day moving average. Now this ratio is starting to head for its 200-day moving average and holding up with a longer term uptrend here, but not any strength under the 50-day moving average, still above the 200-day moving average with S&P growth to value on an end of day basis. This is a little bit concerning. We look at the growth versus value ETFs. We're falling below the rainbow now. The hope was, and what I was pointing out over the weekend, is maybe this black line, which is a 250 period moving average, maybe this would hold. It held before. Well, we've got below this before, only to turn and go back up. So it doesn't mean that all is lost. It just means that this chart's looking a lot more negative right now. And now this depends on how you look at it. This is discretionary versus staples. Now, if you look at an equal weight version of discretionary, it doesn't look all that bad because what's bringing down the other discretionary sectors that we look at? Tesla, it's getting hammered. And so when you take an equal weight version of the discretionary sector, it's holding up okay. But Where we're seeing strength here is on the defensive side, staples, toilet paper, toothpaste, the things that people have to have no matter what's happening in the economy. These are the more defensive plays. And we've been seeing that really coming back on now. And so what that's doing is that's really driving our discretionary to staples ratio down. And it's not so much weakness in discretionary, it's more on an equal basis. It's more strength that we're seeing right now in staples. Okay, large cap growth coming down, dealing with its 200-day moving average. Are we going to get down there? We got close to this before. This was the end of the world day last August. We got down here close back in 2023. Is this going to provide some kind of support? This is the real leadership area of the market. Is the smart money going to say, okay, prices are low enough. We're going to come back in now. Or are we going to get back down here and actually break below this and turn even more negative? All right, as far as our trend, we're not quite there yet in the intermediate term. We're going up with the ADX. That's the black line. It's above its moving average, so it's getting stronger. It's not officially a trend until we get above 20. But this is interesting. You notice how with the down day, the red line came down, but the green line also came down too. You would expect on the down day when we're down 1.76% that this red line would have went up. It didn't. It went down. That just means there is buying going on inside of the S&P 500. Now we are in a trend. We're above 20 and going up in the short term. But the red line's also coming down, but this is now a confirmed negative trend in the short term. And we're well above average here with volume. All right, now we get this once a week. This is a composite of a bunch of different fear gauges, greed gauges, fear, greed, whatever you want to call it. We're coming down, but it still has us on the positive side of things. It's too slow for me. If you look at the gauge that we follow, we're way down over here. Where it's green, we actually show it as red. I say it's negative. We're here, they're saying it's positive. But we're coming in at 62.5 right now with this one. And we did see a lot of insider transactions taking place. This is legal insider. This is when the CEO, corporate officer, not like the first Wall Street movie. That's illegal insider trading. Illegal? That's good. So this really saw some buying coming in the past week and selling as well, but not much of a change here with the insider buying ETF. This has pretty much gone along sideways. All right, then another way of looking at sentiment, the euphoria meter. Doesn't that sound all nice and warm and fuzzy? It's coming down after getting pretty extreme. Folks were starting to take the market for granted on a longer term basis. Market doesn't like that. And so that's why we're seeing things under pressure. And we're above the moving average and going up with the Ulcer Index, another fear gauge that's mainly used with mutual funds because they only have a closing value. And we're above 20 with the VIX. This is usually not a good thing. Now, we could keep going up. We've spiked at other times before here. We'll see if this continues to go up. And we're also above with the bar chart. And the VIX of the VIX also going up, both with the bar chart and with the line chart. That just means there's a real increase in fear. But we're back above 70 here with the speed of the VIX using an RSI based on 9 periods. We're getting kind of extreme right now. Maybe we've gone up a little too far too fast, but we just did that after Thursday. We wore it off after Friday. Now we're back extreme again after Monday. This could still go higher than where it's at right now. Momentum is up for the VIX, and that's negative. And it looked like maybe we were finally going to be able to stop showing this chart, the skew index, which is a variation of the VIX. It came all the way down to the lower end of this red range, and then it spiked back up. So this is a variation of the VIX, where the VIX uses at the money options. If you know what those are, it's where current price is to do its calculation. Well, the skew index looks at out of the money, either above or below current prices. That's how this gets calculated, and usually that just means there's some kind of a big move that's expected. We don't know if it's an up move or a down move, and you can go back at other times and seeing when we finally spiked in this thing, what happened to the market after that. Sometimes it was a top, sometimes a bottom, sometimes a continuation, but now we're going back up again here. And we declined with this fear gauge, where we went up with the other fear gauge. So seeing a bit of a contradiction there. Now, I haven't shown this in a while because it hasn't been really all that scary. This is the spread between risky and not as risky bonds. And we've been getting very high readings, which means there's not a lot of risk right now. Well, this is starting to drop. There's more risk coming in. Now, if this continues to fall, excuse me, that's going to be even more negative. So it's not at freak out point yet, but if this keeps falling, that'll be more cause for concern. And then I plotted here with the S&P. This is an inverted scale of another chart that I usually show. And I also have the VIX here, which is inverted. So it's going down. That means stocks are going down as fears going up. We're seeing a real drop off here with the risk on versus risk off ratio. So to see things internally holding up, which I'll show you in just a moment, and to see this ratio going down, yeah, the market's getting more defensive right now. But we're still going up. If you think we're having trouble with the S&P, small caps are just really getting hammered. And so even though the large caps are not doing all that well, small caps are doing worse, and so that's why we're seeing this ratio going up. And we went up here with the daily chart of the equity put call ratio. We're going up with the 5-day chart and the 10-day chart. That just means fear is increasing as there's been an increase of hedging for the S&P 500. And this was Friday's chart. Isn't that good? This is Friday's chart as well. Okay, I forgot to delete some things here. I apologize for that. I did that over the weekend too. Imagine that. Okay, this is actually kind of encouraging for the time being. The volatility risk premium actually dropped. So it's picking up a decrease in fear based on how it's calculated. Now, this is where we look internally at the S&P, and you notice the advanced decline line? It's kind of humming along. It's not showing a lot of weakness. So it's not like money's coming out of the S&P. It's just going from one part to another part of the S&P. And we're holding up okay here with the volume, and longer term, we're positive because we're above these advancing moving averages. And we see this. It declined a little bit here with our advancers decliners over a 10-day and then developing this like an oscillator so we get extreme positive or negative readings. We're still above zero here. And you look at the new highs, new lows. Look at that. With the higher open that we saw, bunch of new highs were generated. But then as we went down, a bunch of new lows were generated too. But we're seeing a lot more green up here, new highs, than we are red, new lows. We're rolling over here with the 5-day, and we're getting flat now with the 10-day moving average of this red-green A relationship. And we're still above zero with the advanced decline ratio, short term and intermediate term. And we're still above the moving average with accumulation distribution. So we're seeing some mixed signals now with our smart money indicators. Even though this came down, it's still above the red line. But we're still negative here. But look at this. The Chaikin money flow actually went up in Monday's session. We're down 1.76%, and this goes up. Somebody's doing some buying. And it looks like it's more defensive, but the red line is still going down. So this smart money indicator is negative for the time being. And we bounced up a little bit here with the Chaikin oscillator, but it's still negative as well. Actually, that one went down a little bit. And we're coming down a little bit with the vortex. It's picking up some under the surface buying here, but we're negative because the red line is above the green line. But we're not seeing all that big of a change. The cumulative advanced decline line for the S&P, just chopping along. Not that drastic of a change based on volume. Okay, and then when we compare the S&P 500 with the NYSE advanced decline line, they're both going down right now. Not a real surprise there. The cumulative advanced decline line is seeing some weakness, but the regular advanced decline line just kind of chopping along. This other one chopping along above its 50-day moving average. So it's not like the market is falling apart. It's shifting. When we look at the common stock based on price, a little bit of a decline here, a little bit of a decline based on volume. This is internally, we are showing some weakness here. This is the new highs, new lows for the NYSE, and we're below zero. That's the black, that's the daily value. And then over top of this is a 50-period moving average. That's still hanging on to being positive. But if it drops below zero, that's going to turn things in a broader sense more negative. And then we look at that same thing with the highs, new lows for the S&P. It's holding up on a day in and day out basis. And actually, we look at the 50 period moving average, which I broke out down here. This is hanging in there for right now. And we're hanging in there with the advanced decline line for the S&P. Now, the NYSE common stock declined, mid caps, small caps, they're showing more weakness underneath the moving average. And then we look at another broad market measure with the new highs, new lows over a 5-day period. This is turning more negative as well. And we've been chopping above and below 50 here with the stocks inside the S&P that are above their 20 period moving averages. We go a little bit below, then back above, then a little bit below. Not falling apart, but negative now. And we're also back below 50 with the 50 period moving average study, the 100 period moving average study, and we're declining with the 200 period moving average study. And now it's a little easier to see because we've kicked into the new month, and so the pivot points here have shifted forward a little bit. Where, yeah, are we going to come down and test the 200-day moving average? Now we're right at a pivot point here, which is acting as support. That's the dashed line. This was one for February. Now we're rolling over and going to be looking at new pivot points for March. That's why I update these every day on the YouTube community tab. And declining, but not falling apart here with the 20, 50, and 200 period moving averages. But we're getting extreme with the S&P getting kind of far away from its 20 period moving average. We're below 100 now. And we're declining with the 50 and we're declining with the 200, but we're not extreme, at least yet. But we're starting to show the momentum is shifting back more negative with the Stochk RSI, the Williams percent R, CCI 14, and the CCI 20. The stochastics are extreme in the short term, intermediate short term, declining but not extreme with the long short term. And we're going back down after we had been trying to bounce a little bit here with the force index, but we're not extreme with this one. The short-term trend is looking more vulnerable. We're below the lines, and the lines are declining here. And we're below the simple and exponential moving averages, and the lines are going down. That's why we're in a short-term negative trend. We're not extreme. We're still in the -2 channel with our standard deviations chart. If we continue to fall, we might go into the -3. That means we're going down pretty fast in the intermediate term. We are back to negative again with the balance of power dropping below zero. We're negative with the go, no go with the deep purple smoke on the water bar. And we're getting down to the lowest low value here with this chart. TTM squeeze is negative. We're dropping back below some of these anchored moving averages. It looked like, okay, maybe this one is acting now as overhead resistance. Well, we fell back down below this purple line. Now, this goes back to a pretty significant low that was set last summer. And this is an anchored moving average going forward. If we drop below that, because that was the end of the world day, if we drop below that, things might turn more negative, where we have more of an intermediate term low here with this orange line, and then a more significant low that was set almost a year ago in April. These are pretty significant support levels. And if we lose those, which we haven't yet, so we're just speculating, we're just observing things before they happen. If we lose these levels, especially this blue one here, that is going to be more negative. And we're showing standard deviation really picking up. This is measuring speed over the last 10 periods, and we've been going down pretty fierce. And ease of movement is negative. We're below the midpoint. We're negative with the Arun indicator. The oscillator here is below zero and declining. And we're dropping back. We were positive after Friday. Now we're dropping back slightly negative with the McClellan oscillator for the S&P. So we're just ticking down ever so slightly based on price. We were already declining based on volume. We're still negative with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume. And we're flat. We're actually turning positive with the swollen trading oscillator after Friday, but we're flat based on price and volume here. It's not seeing anything more negative, but it's not seeing anything positive right now. Momentum, though, we are negative. The PMO, and we're crossing below the midpoint. We're declining when we break this out based on price as well as volume. Little bit of a deterioration, but we're right around the midpoint when we look at the PMOs that are rising. Again, that just shows some of the rotation that's going on inside the S&P. Seeing a bit of a decrease now with the buy signals, and we're flat to slightly declining, but not really headed down drastically with the PMOs in the S&P that are above zero. We're going down here with the Sean trend meter, but we're in more neutral territory. And we're starting to get extreme negative with our short-term oscillator. The slope oscillator is getting down below this red line. The MACD below zero, declining below its moving average. That's negative. All of our oscillators are going down, short, intermediate, and long term. Another momentum oscillator, the Copic curve, is also going down. We're starting to drop below 50 with the money flow. We're declining below 50 with the ultimate oscillator. We're still hanging out above the moving average with unbalanced volume, but we're below 50 with the RSI 14 and the RSI 9. We're negative with the Elder's Impulse system for the S&P since we went from neutral after Friday to negative with a red bar. We're negative with the parabolic SAR. Now, over the weekend, the weekly parabolic SAR is still positive. We'll have to see if it ends up staying that way, but we have to wait for the week to finish out to get an official signal. And here's the condition of the intermediate term trend, looking vulnerable. Blue line, red line going down, prices below both. And we're below the 50 period simple and exponential moving average. We didn't quite get back up to that level as overhead resistance. That was at about R1, which we never hit on Monday. We didn't quite get up there. Then we started dealing with the 100 period moving averages. This is right where we closed on Friday with the green. That's the simple period, simple 100 period moving average. And we came up to this pivot point here, kind of interesting, and then came down. So now we have to start watching the 200 period moving averages. The 100 has not held now. And we're below zero and declining with the bullish percent index. We're declining with the NYSE bullish percent index. We actually ticked up a little. Isn't that interesting? We're negative with the bullish percent index for the NASDAQ 100, but it did advance slightly. And why I went through and I thought I did these things here. I apologize for this. I've been wrapped up in all the news stuff that's going on here, and I guess I've been forgetting to delete some of these charts. So sorry about that. I try to make these a little bit more professional here. Okay, and now we're losing support again with the Ichimoku cloud. That was after Friday. And this is also after Friday. My goodness, here. We are declining, though, with the trend basis. The Heiken Ashi is clearly negative, and we're negative with the Kegi chart. We're red and pointing down. We're red with the Renko chart. We're red with the three-line break. No Friday charts. Okay, here's what I wanted to show. This is where we're falling back below the Ichimoku cloud, the green cloud, and now the red line and the blue line are going down, and the green line, it's a little easier to see now. They're all going down. So this chart is turning more negative, at least in the short term. And we're declining, but still above this blue line with the 150 and 200 period moving averages. This is the long-term chart here. My interpretation of this is we hit this back in early December. We would try to get a little bit above it, and that's when the market would stall out. This is a long-term trend channel that is acting as overhead resistance, and we just have not been able to get below or get above that, at least for any length of time. Then we are negative in the short and intermediate term with all the stock indexes that we look at. And bonds are positive in the short and intermediate term because they've been going up based on price. Commodities have now switched to being negative in the short term. The dollar's back to an uptrend across the board on all time frames. And you look here, real estate, staples, healthcare, utilities. Defensive areas were actually up. Growth areas down. Economic areas down. Now, one area that energy, okay, we'll have to see how that goes. Awful lot of red here. We had a BPI cross below 50 with the communication sector. That's growth. Then it looked like, well, NASDAQ above 18.9, Dow getting back above 44,000. No, it didn't last very long. Then the NASDAQ 19.8, 19.7, 19.6, 19.5, 19.4, 19.3. Yeah, kind of went down below its 200-day moving average. NASDAQ, let's see, healthcare, this is defensive. BPI across above 50. The euro was showing some strength against the dollar. But then we had the S&P going down below 5,900, and the Dow went back down below 43,000. So promising start, disappointing finish if you're positive on the market. And we're going down here both with the weighted and equal weighted version of the S&P. We're seeing this going down as the weighted version is underperforming the equal weighted version. That also suggests some rebalancing going on here. The Dow continues to come down. We're possibly hitting this S1 support level, which may provide some support there. Because over the weekend, when I look at all six indexes, the Dow's in first place, and even it's not looking all that great. But on a scale of 0 to 100, the Dow's holding up the best. Maybe not after Monday, but we're negative here with the Elder's Impulse system. And here's the NASDAQ. We bounced up off of the 200-day moving average. That's when I decided to close out some bearish short-term positions. Well, now we're back down below the 200-day moving average. So this has been a failed test up to this point. What's holding up right now is the 200-day moving average for the NASDAQ 100. That's big. The big stocks, the mega caps. If this drops down here, that is going to turn things more negative. But beware, we could overshoot this, and there's probably millions of stop loss orders set up right underneath this level, and they'll all get triggered if we do drop down here. And then that's called gunning for stops, where they clear out all these stop loss orders, and then the smart money says, "Okay, any more dumb money stop loss orders? Okay, they're all gone. Let's go buy and take this thing higher." It's a game. It's part of how this whole thing works. But we'll be watching this 200-day moving average here. And we're negative with the Elder's Impulse system for the Qs. Momentum is negative for the NASDAQ 100 and small caps. Just taken out and shot. Not even really down to this S1 level yet. It could fall down a little bit more, but just not looking good right now. And we were already getting extreme with the RSI with the Russell 2000 small caps, but we're well below the 200-day moving average here, and we show the momentum is negative. Also negative with the mid caps, and we're dropping further below the 200-day moving average. We came down to this S1 level here, and so far that's holding. There was a time about a year ago when the markets actually keyed off of the mid caps. We found some support and then bounced up out of that. I don't know if that's what's happening here, but we still want to watch this in case that is something that ends up happening. And we're negative with the Elder's Impulse system for the mid caps. The Wilshire taking a hit, still under its 50-day moving average, but in a longer term uptrend. Also, the total US stock ETF down 1.9% underneath its 50-day moving average. And now I wanted to point this out because the banks are back down to below their 50-day moving average. We want to keep an eye on the financial sector, which is the next chart. And it hit an all-time high on Friday, and we like that. So we're not necessarily seeing any real weakness here, according to this chart. On a relative basis, the financial sector still has quite a lot of work to do. But for right now, this is hanging in there. And this is also showing that the market's getting more defensive. The staples to SM to tech ratio here really going up. Folks are getting more defensive. Staples, toilet paper and toothpaste instead of computers and computer chips and AI. If this really keeps going up, yeah, that's going to be a concern. And here is the FANG index, which was down almost 3%. These are the really big stocks as well. Apple was down 1.58%. We had Amazon down 3.42%. Google down underneath its 200-day moving average. Microsoft, which is now in a downtrend with the moving average crossover. This is a death cross. It was down over 2%. Meta, still above its 50-day moving average, but dropped almost 2%. Nvidia, underneath its 200-day moving average, came out with this great earnings report last week, but it wasn't great enough, and it fell 8.69% on Monday. And Tesla, now, it's still above its 200-day moving average, and it fell 2.84%. If we drop below this, now we've dropped below it before, but we'll see if this ends up holding as some kind of support. If Tesla goes up, this would help discretionary. If Tesla goes down, that's probably going to put more stress on discretionary. Netflix down 0.7%, just coming off of a recent all-time high, though. And I want to keep an eye on the semiconductors. There's this tariff thing and all kinds of stuff going on, and semiconductors are getting hit hard. This is the Dow Jones Semiconductor Index. It's still in an uptrend. You notice the blue line still above the red line, but it's falling below its 200-day moving average. And then this is the SMH ETF. Just it's falling below its rainbow now. And then we look at the semiconductors to Dow ratio. This is continuing to go down, which is also more negative. And this is a newer ETF that I started showing over the weekend. I just wanted to, show you here. This is the AI and tech ETF. Now I have an AI and robotics ETF that I didn't think was really representing what's really going on so much. So I found this other artificial intelligence and tech ETF, and it got hit over 2%, but it's still in a longer term uptrend. And this is part of the overall rage of the whole AI thing that's going on. And we're seeing kind of not much of a change here in the short term relationship between US stocks and world stocks, but we are seeing the longer term correlation dropping off. Now, it's not because of US stocks, it's because world stocks are holding up just a little bit better lately than US stocks. Oil, we're still down below 70 and dropping. So if we're freaking out geopolitically, that's not causing oil to go up, at least right now. The dollar is still in an uptrend and kind of stabilizing in the 106 area. And this is another thing that we want to keep an eye on. Now, with the 10-year yield, we're dropping below the 200-day moving average, where we were just about on it after Friday. That could be positive for interest rates going down. And we're going up based on price. All right. And now we want to keep an eye on this. This is to try to determine, does the market anticipate a recession or that we're not going to go into a recession? This is a stocks to bond ratio where we've been above this rainbow for other than little blips down going back to, well, midway through 2023. This is weakening now, but it weakened before and we bounced up out of this. If this continues to fall and we drop down into this hard landing area, that means that the market will anticipate a recession. So I watch this every day. I usually only cover it in the weekly videos, but I wanted to bring it up here because we need to keep an eye on this to see if things are really starting to shift. This is another thing that I usually bring out over the weekend, but we're seeing this coming down. Now, if there was concern about inflation and interest rates, this would be going up. Now, it's still in an uptrend, but lately it's been really dropping off as we've hit this recent rough patch in the market. But when you look at the tech sector, says bonds, we're dropping below the rainbow. That's not a good sign right now. Home construction, which has been weak anyway, going back to 2024 when we broke below the rainbow, this continues to fall because this is a very high interest rate environment, but interest rates are going down. How come this ratio is still going down if interest rates are going down? If making this go down was interest rates going up? What's going on here? All right. And then we're keeping an eye on the 10-year yield in Japan. And now it's right around the 1.41 area here because that's what caused the problems last summer. All right. Now, this is the 10 to the 2 yield curve, which is not inverted. We're above this blue line. Okay. So that's not inverted. But when we look at the 10 to the 3 month, we've been inverted for, I think, 3 days now. We drop back down into this red area. And this means that part of the market is anticipating problems in the economy. And then when we go back to not being inverted anymore, that's when we start a countdown to say, okay, 5 months from now, 6 months from now, usually the average time until we go into a recession. All right, then we're not seeing really anything good here now. With our growth to value ratios, Q's to S&P going down, discretionary leveled out, but it's still declining. Discretionary to S&P, large cap growth is underperforming large cap value, going down with the large caps, mid caps, and small caps. And this is going up. Staples to the S&P 500. We saw the staples to tech, that's spiking up. Well, we're seeing staples to the S&P 500 going up as well. That means the market is getting more defensive. Okay, so we are negative in the short term when we look technically at the market here, but we're becoming oversold in the short term. We're not going to have any economic reports on Tuesday and then the geopolitical things. And who knows? From the time I start recording this until the time I finish, I go check the news headlines and it could be completely different list of things happening there. But President Trump will be addressing Congress in kind of a pseudo State of the Union thing. And the Democrats are going to boo his hoss and give him mocking, clapping, or rip up his speech or do whatever they do, where the other side's going to, yay, 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 USA, USA. So it's the world we live in now. But we want to keep an eye on a lot of things are in motion, dealing with the Russia-Ukraine war. A lot of things are happening between the US and Europe right now. Okay. And then the tariffs are supposed to be kicking into gear. Now we're going to get the ISM non-manufacturing or services on Wednesday, and then we get jobless claims every week on Thursday, as well as productivity and unit labor costs. And then the big employment report will come out on Friday. This is just highlighting Wednesday, the next big things to happen because there's nothing economically happening on Tuesday. Now, seasonally, for March 4th, we tend to march down, not March 4th. We are negative with the Dow and S&P, and we're neutral to negative with the NASDAQ. Here's the calendar showing pretty choppy for March now, whether you look at what has historically happened or in a post-election year. Not we are not really positive for the 4th. Now watch, we'll have a monster up day because there have been times when we've totally gone against seasonally what typically happens. But the first half of March, now Monday was a very positive seasonal day. Tell that to what happened. Okay. The first half of March tends to perform well, where the second half does okay, but not great. And then this is an updated chart here. How you want to measure this. All post-election years, that's in black. We're coming down and kind of matching that. Incumbent party loses. That's what happened. That's the purple line. The aggregate, that's green. Okay, we're kind of blowing below that. And what's rep admins? Is that Republican administration? That's probably what that is there. Okay, you can tweak you can, if you dig deep enough with these numbers, you can come up with anything you want to say. All right. Then the Carson cycle, it's a composite. They cram a whole lot of things together. Basically, they say from February through about April to see choppiness right now is quite normal. But March tends to perform better than February. Average return 1%, up 65% of the time. All right, now we're seeing a mixed picture here with our smart money indicators. We're still positive, but declining with accumulation distribution or the Chaikin money flow. It went up, but the red line's still coming down. And the Chaikin oscillator is actually looking more negative. Where the S&P and NYSE McClellan oscillators and summation indexes, they're negative. All right, the parabolic SAR is negative. The bullish percent indexes are negative, even though the NASDAQ 100 ticked up just a little bit. On a momentum basis for the S&P, we are negative. Ease of movement, ultimate oscillator, vortex, these are all negative. And the momentum for the NASDAQ 100. And then the growth of value. Now, what I'm measuring this on and why I'm saying it's positive is because of those longer term trends. But shorter term, we're getting hit pretty hard right now. And the same thing is true with discretionary to staples. Then the advanced decline lines, they're positive because of the S&P. But if you look at the rest of the market, we're falling below the moving average. And we're flat with the Swindler trading oscillator. The money flow just barely there. And the financial sector is still looking positive, but now the banks are underneath their 50-period simple moving average. All right, so our conclusion, we're negative in the short and intermediate term, but we're still positive in the long term. Are we going to test the 200-day moving average? And we're looking more oversold in the short term, and we're looking also more negative there. We're just flat out negative in the intermediate term, but we're not really seeing anything all that extreme, at least to this point, where we're still positive in the long term. Thank you. I really hope you found this helpful. Have a great day, and I will talk to you in the next video.